EPK Capital presents Daily Brief for 22 September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your AI host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Global financial markets presented a nuanced and often contradictory picture over the last 24 hours with a mix of momentum, consolidation, and new tensions shaping trading narratives. While U.S. markets paused after reaching all-time highs, propelled by post-Fed optimism, their Asian counterparts exhibited a more fragmented response, influenced by a blend of internal policy shifts and external geopolitical friction. The primary forces at play were macroeconomic policy, particularly the lingering effects of the Federal Reserve's recent interest rate decision, and key political announcements that had a direct and immediate impact on specific sectors. The most notable event was the immediate market reaction to a policy announcement from the Donald Trump administration, which sent Indian IT stocks into a nosedive at the market's open. This short-term turbulence, however, played out against the backdrop of a significant and powerful long-term domestic narrative in India: the implementation of the new GST 2.0 reform. This internal stimulus is poised to provide a substantial boost to consumption-driven sectors, creating a dualistic market environment. Concurrently, the Federal Reserve's recent rate cut, while intended to support a weakening labor market, has created a curious dynamic where long-term Treasury yields paradoxically climbed, signaling a fundamental divergence in expectations between the central bank and market participants. In the digital asset space, a sudden price reversal saw major cryptocurrencies like Bitcoin and Ethereum pull back from recent highs. This volatility coincided with a flurry of global regulatory developments, from Bahrain's new stablecoin framework to the UK's nuanced approach and Vietnam's calculated pilot program. These developments suggest a maturation of the crypto market, where regulatory clarity and institutionalization are becoming more significant drivers than traditional macroeconomic catalysts. The report that follows provides a granular breakdown of these events and their potential implications. Section 1. Global Market Performance, a snapshot of key indices. Financial markets across the globe on Monday, September 22, 2025, reflected a complex blend of momentum and caution. After a week of record-breaking gains for many indices, the trading session saw a period of consolidation as investors sought fresh direction from new data and political commentary. The North American picture, pausing after a record run. Major U.S. indices closed the previous week on a high note, continuing their ascent following the Federal Reserve's interest rate cut. On Friday, September 19th, the S&P 500 finished the day up 0.49%. The Nasdaq Composite climbed 0.72%, and the Dow Jones Industrial Average gained 0.37%. This momentum had propelled these indices to new record highs, with the S&P 500 and Nasdaq setting all-time records, and the small-cap Russell 2000 posting its first record close since late 2021. However, as the new trading week began, the U.S. markets were described as flatlining, with attention shifting to a phone call between President Trump and Chinese leader Xi on trade-related matters. The modest price movements on Monday followed a period of elevated expectations, with market observers noting that September and October can be seasonally volatile. The current values of these indices on September 22nd, based on the latest available data, are summarized in the table below. European and Asian markets, a mixed bag. Across the Atlantic, European indices signaled a continued, albeit cautious, risk appetite. The DAX Performance Index saw a modest gain of 0.15%, while the FTSE 100 Index edged up 0.014%. This positive sentiment contrasted with a more fragmented performance across Asia. Japanese markets were a standout, with the Nikkei 225 gaining 1.42%, and South Korea's Kospi rising 0.69%. This upward movement in Japan came despite the central bank's decision to keep rates unchanged and its plans to sell off substantial exchange-traded fund holdings. However, The Hang Seng Index in Hong Kong slipped 0.43%, while mainland China's CSI 300 posted a marginal gain of 0.10%, indicating a divergence in regional sentiment. This mixed picture underscores the varying influences of domestic policy and broader geopolitical tensions on individual Asian economies. The Indian market's dualistic opening, the Indian equity benchmark indices, the Nifty 50 and the BSE Sensex, started the week on a negative note, a stark contrast to their three-week winning streak. At 9:16 a.m., the Nifty 50 was trading down 0.38% at 25,229.70, and the BSE Sensex was down 0.42% at 82,279.92. This negative opening was directly attributed to a geopolitical event, the Donald Trump administration's announcement of a significant increase in H-1B visa fees. The news caused a sharp reaction, with IT stocks in particular tanking at the market's open, given the sector's heavy reliance on H-1B visas for its U.S. operations. This immediate external headwind was a defining feature of the day's early trading in India. Section 2. Macro Events and Policy. The Driving Narratives. The market's performance over the last 24 hours was not random. It was a direct consequence of a series of intersecting and sometimes conflicting macroeconomic events and policy decisions. The Fed's aftermath, a duel over the rate path. The financial world is still calibrating to the Federal Reserve's decision on Wednesday, September 17th, to cut its target rate by a quarter percentage point to a range of 4.0% to 4.25%. This marked the central bank's first rate reduction in 9 months and was largely expected by the market, which had been betting heavily on an easing cycle. The Fed's updated projections, or dot plot, suggest that 2 more cuts are possible before the end of the year, signaling a broad direction of travel for rates that is lower, with the goal of gradually neutralizing policy. However, a closer look at market behavior reveals a significant divergence in expectations. A rate cut is typically a signal that would lead to lower borrowing costs across the economy and a drop in bond yields. But in the days following the Fed's decision, long-term Treasury yields, particularly the 10-year Treasury note, paradoxically climbed. The 10-year yield rose to nearly 4.113% after initially dipping below 4% immediately after the rate cut. This movement suggests that, despite the Fed's dovish pivot, a substantial segment of the market does not share the same outlook. The prevailing belief among these market participants is that future inflation may be more sticky than the central bank's projections account for, particularly as the effects of the Trump administration's tariffs work their way through the supply chain. This dynamic sets up what some analysts are describing as a duel between the Fed and the market. The central bank's projections for rates are more conservative than futures trading, and this difference in perspective could lead to heightened volatility as investors and policymakers each wait for the other side to flinch first. The rise in long-term yields reflects a more optimistic economic growth outlook and underlying fiscal concerns, which are signals that contradict the Fed's stated reason for easing policy, a cooling labor market, and rising downside risks to employment. This situation poses a challenging balancing act for the Fed, as it navigates the tension between its dual mandate goals of price stability and maximum employment. Reading the U.S. economy's vital signs, conflicting data. The rationale behind the Fed's rate cut was its assessment of a weakening labor market. However, recent economic data has presented a complex picture, requiring a careful and nuanced interpretation. The Chicago Fed National Activity Index, CFNAI, for July was reported at 0.19, a level that signals below-average economic growth. This figure is a key indicator of broad economic activity, and its negative value provides support for the central bank's decision to ease monetary policy. It is important to differentiate this from other similarly named reports. The Chicago Fed Survey of Economic Conditions, CFSEC, suggested that economic growth improved in August, with its activity index increasing to +1 from 22 in July. However, the official CFNA data for August has not yet been released, making it impossible to definitively declare a turning point in the broader economy based on the most widely cited index. A misinterpretation of these two reports could lead to a misleading conclusion about the state of the economy. While the CFSEC points to a potential positive trend, the more comprehensive CFNAI still shows a continued slowdown as of July. This highlights the need for precision in economic reporting and analysis, as a single data point, if taken out of context, can paint an incomplete picture and lead to flawed market assumptions. India's dualistic market, geopolitics versus domestic reform. The Indian market's negative opening on Monday was a direct consequence of a political announcement from the United States. The Donald Trump administration's decision to impose a one-time H-1B visa fee of $100,000 had an immediate and palpable impact, particularly on the IT sector. As the IT industry heavily relies on this visa program to staff its U.S. operations, shares of major tech firms in India tanked at the market's open, contributing to the initial decline in the Nifty 50 and Sensex indices. This external geopolitical headwind, however, is playing out against the powerful backdrop of a significant and transformative internal reform. Monday, September 22nd, marked the official launch of India's GST 2.0 reform, which simplifies the country's tax structure from multiple slabs to a simpler two-tier system. This change is projected to inject a massive Rs 2 lakh crore back into consumers' pockets, essentially functioning as a large-scale consumption stimulus. By reducing taxes on a wide range of goods and services, from daily essentials and medicines to automobiles and home appliances, the government has timed this reform to coincide with the start of the festive season. This creates a unique dualistic behavior in the Indian market. While the IT sector is suffering a short-term setback from the visa policy, the broader economy is set to receive a powerful long-term boost from increased consumer spending and reduced prices. This domestic tailwind is expected to drive what analysts are calling one of the best consumption booms in recent times. This confluence of events suggests that while global political decisions can still create short-term market friction, the Indian market's increasing maturity and powerful internal drivers are capable of providing a counterbalance and a long-term path to growth, demonstrating a new phase of market resilience. Section 3. Political commentary and geopolitical crosscurrents. Beyond specific market-moving data, the commentary and policies of global political figures continue to shape the financial landscape. The influence of political rhetoric and long-term regulatory policy on markets is profound, and the last 24 hours provided several key examples. Trump's policy and market friction. The Donald Trump administration's policies have been a consistent source of both market friction and central bank concern. Federal Reserve Chairman Jerome Powell has repeatedly noted that the administration's tariff policies have had a discernible effect on consumer prices, stating that these effects are now clearly visible and are expected to accumulate over coming months. This dynamic complicates the Fed's efforts to manage inflation while also supporting a slowing labor market. President Trump has also been a vocal critic of the central bank's pace of rate cuts, publicly calling for a more aggressive approach. This political pressure has created a delicate environment for the Fed, which has consistently reaffirmed its commitment to setting monetary policy decisions based solely on their assessment of the data and free from political influence, long-term policy, and the future of big tech. While much of the market's focus is on day-to-day events, the long-term policy direction from regulatory bodies provides crucial insight into future market trends. Assistant Attorney General Gail Slater's recent speech on unleashing innovation the American way provided a clear signal regarding the Department of Justice's long-term stance on technology and antitrust. In her remarks, she emphasized the importance of using monopolization remedies to open up markets and foster competition. This is a significant statement, as it indicates a firm commitment to ongoing regulatory scrutiny of big tech firms. The government's goal is to create a landscape where smaller innovators can compete without being blocked by exclusionary practices. This is not just passing political rhetoric, It is a core policy direction that will have lasting implications for the valuation and strategic direction of major tech companies, influencing investor sentiment and corporate governance for years to come. Section 4. The digital asset landscape. The cryptocurrency market, known for its rapid and often unpredictable price swings, experienced a notable reversal in the last 24 hours, even as the global regulatory environment for digital assets continued to mature at a rapid pace. Crypto price action, a sudden reversal. After gaining momentum in the days leading up to the Federal Reserve's rate cut, Bitcoin and Ethereum experienced a significant pullback. Bitcoin, which was trading near $117,000 last week, was down by more than $2,000 overnight and was last noted at a current value of $115,304.5. Similarly, Ethereum, which had been rebounding toward the $4,500 mark, dropped below the $4,200 level and was trading at a value of $4,196.35 as of Monday morning. This volatility was accompanied by large-scale liquidations, signaling a classic short-term risk-off event in the market. The regulatory onslaught, the new drivers of crypto's future. While short-term price movements often grab headlines, the more significant long-term narrative for the cryptocurrency market is the accelerating global regulatory race. A series of announcements over the past several weeks indicates that governments and financial authorities are moving to institutionalize digital assets. Bahrain's stablecoin framework. The Kingdom of Bahrain has taken a calculated and pioneering step by rolling out a comprehensive new law to govern Bitcoin and stablecoins. The framework, known as the Stablecoin Issuance and Offering (SIO) module, mandates that stablecoins maintain a 1.1 backing in cash or liquid assets, and that issuers hold a minimum paid-up capital of BHD 250,000. This move positions Bahrain as a potential sandbox hub for crypto policy in the Middle East and North Africa (MENA) region, as it provides a clear roadmap for attracting serious, well-capitalized players while ensuring robust investor protection and anti-money laundering standards. The UK's nuanced approach. The UK's Financial Conduct Authority, FCA, is also moving to integrate the crypto sector into its regulatory framework, with new rules expected to be implemented next year. The FCA's approach is not to simply copy traditional financial regulations, but to adapt them to the unique nature of crypto assets. For example, the new rules will exempt crypto firms from certain principles that govern traditional finance, such as those related to due skill, care, and diligence, and cool-off periods after a purchase, acknowledging the volatile nature of the asset class. At the same time, the FCA plans to enforce stricter rules in other areas, particularly those covering operational risks like IT outages and cyber attacks. Vietnam's calculated pilot program. In a bold move on September 9th, Vietnam launched a 5-year pilot program for crypto asset trading. The program, which features strict controls and high capital requirements, is a sign of the country's cautious yet progressive entry into the regulated digital finance market. Initially, the program will limit participation to foreign investors in order to protect the domestic foreign exchange market, and all transactions will be required to be conducted on licensed domestic exchanges. The rapid development of these frameworks suggests that the primary focus of the crypto market is shifting away from being a purely macro-sensitive risk asset. The market's recent price decline, despite the Fed's rate cut, seems to affirm this. As institutional interest grows, the stability and credibility provided by regulatory clarity may prove to be a more powerful long-term driver than short-term central bank policy. The future growth of digital assets may depend less on central bank announcements and more on the ability of governments to create clear, fair, and robust regulatory frameworks that attract institutional capital and foster mainstream adoption. Cryptocurrency market snapshot asset latest price, 24-hour change, the 24-hour change, percent, weekly change, percent, Bitcoin, BTC, 115,304.5, 411, 0 hour, 0.36%, Pi 4 30%, Ethereum, ETH, 4.196.35, 251.48, 5.65%, Pi 4.04%. Note, Bitcoin and Ethereum prices were noted to be down by more than $2K and below 4.2K, respectively, in overnight trading as of September 22nd. Section 5. Looking ahead, insights and forward-looking analysis. The events of the past 24 hours provide a clear roadmap for the narratives that will dominate markets in the coming days and weeks. The interconnectedness of geopolitical, macroeconomic, and regulatory forces is becoming increasingly apparent. Anticipated market themes for the week. The duel between the Federal Reserve and the market over the future path of interest rates is poised to be a central theme. The market is pricing in a more aggressive easing cycle than the Fed's own projections suggest, and this divergence will be tested as several Fed officials are scheduled to deliver remarks this week, including Chairman Jerome Powell himself. Markets will be carefully parsing their comments for any signs of a shift in the central bank's perspective on the labor market or inflation, and any unexpected message could trigger significant volatility. In India, the market will serve as a key battleground between external headwinds and domestic tailwinds. While the H-1B visa issue created a short-term negative impact on the IT sector, the long-term effects of the GST 2.0 reform are expected to be far more profound. Analysts predict that the GST cuts will drive a material improvement in earnings from the third quarter onwards, providing a durable push to consumption. Finally, the cryptocurrency regulatory race will continue to be a dominant narrative. The pioneering moves by Bahrain, the UK, and Vietnam signal a global trend toward providing clear regulatory frameworks. This is a crucial step toward attracting institutional capital and integrating digital assets into the mainstream financial system. Future price action and market sentiment may be increasingly influenced by similar announcements and the institutional flows they attract. Key sectors and stocks to watch. Based on the macroeconomic and policy developments, several sectors and companies are positioned for significant movement. Indian consumption stocks. The GST 2.0 reforms are expected to provide a substantial boost to consumption-oriented sectors. Companies in the auto, consumer durables, and fast-moving consumer goods (FMCG) industries are direct beneficiaries, with price cuts already rolled out on everything from refrigerators to cars. This fiscal stimulus, timed for the festival season, is expected to lift sales volumes and drive stronger earnings growth in the coming quarters. It as a contrarian play. While the Indian IT sector has been the worst performing of the year and was hit by the visa news, some analysts view it as a compelling contrarian opportunity. It is argued that much of the negative news is already priced in, and with a potential recovery in US tech spending and healthy dividend yields, these stocks could present an attractive entry point for long-term investors. Analyst picks. For investors looking for specific opportunities, analysts from Motilal Oswal Financial Services have identified two top stock picks for the week: Punjab National Bank and Larsen & Toubro. Punjab National Bank is cited for its transition to a fundamentally stronger franchise, with improving asset quality and robust loan growth guidance. Larsen & Toubro, meanwhile, is noted for securing large orders in infrastructure projects, reflecting its dominant position in a sector that is a key theme in India's national push for development. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.